investors a few years ago treated every SaaS companies like all of them would eventually become Microsoft or Intuit one day, and it seems like nothing can go wrong. And till today, like the narrative is like artificial intelligence AI is eating software. So so the sentiment has shifted like completely. Like SaaS businesses went from being like an ideal business models to like being extremely vulnerable with the emergence of AI.
All opinions expressed by Chris, Michael, and Ryan are solely their own opinions and do not reflect the opinions of 5i Research or i2i Capital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 16th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by my co-host, Michael. Welcome, Michael.
Yeah, thanks for having me as usual, Chris.
Yeah, not a problem. Yeah, it's always great to chat with you. And I mean, since last we've spoke, it's been at least a month or two, and the markets are pretty much roaring higher. Nothing really seems like it can take the markets down. It seems like there's a lot of cash on the sidelines that keeps chasing the market higher every time there is some sort of slight pullback. We're getting economic releases that are signaling, future rate cuts are coming. There's also recently a U.S. government shutdown, but yet the markets keep marching higher. So it feels like a really healthy sort of market where, there's just a lot of cash on the sidelines and dips are being bought. And yeah, it's kind of between, a pretty solid U.S. Economic landscape in terms of GDP growth and things like that, mixed with future rate cuts. It seems like we're in a bit of a Goldilocks kind of period. So I wanted to get your thoughts on just general market musings.
Yeah. It seems like this market like could do no wrong. Like already up double digits for both the S&P and the Nasdaq. Like everyone is happy. This year should end like a solid year, especially with a backdrop like a declining interest rates and all that stuff. I think here and there we still find like opportunities, and we will discuss in this podcast today what we find interesting in this market.
Yeah, definitely. Yeah. And it really feels like, at the beginning of the year, we heard a lot of investors talking about like double-digit market returns back-to-back consecutive years. So there was a lot of like investor doubt at the beginning of the year. But here we are entering Q4. Markets are mostly up double digits, and there's a decent chance that we'll see 3 consecutive years of double digits. So pretty solid, and yeah, it's following kind of what was a pretty rough 2022. So it's also somewhat warranted as well. So, let's, I'll talk about the few categories that we're going to be talking about today. So you and I both will be going over a Canadian small cap name. And then you're going to be talking about public SaaS companies and the AI theme. I'll be doing a couple segments on, interest rates and market returns, looking at Constellation Software, CSU historical returns analysis. You'll be discussing one interesting ETF. And then I'll be going over kind of a mental model or mental framework for Bitcoin. So with that said, do you want to start us off with your small cap name?
Sure. Yeah. Let's do it. So the small cap I'm talking about today is Blackline Safety Corp. The ticker is BLN. So it is quite a bit under the radar kind of growth name recently. So Blackline Safety is like the developer and manufacturer of worker safety monitoring products and services. In recent years, the company has been shifting from a product-driven business to a service-based business model. Uh, Therefore, like significantly increase its recurring revenue portion as a total of total sales. Um, Also, gross margins have improved tremendously from like just 40% a few years ago to 62% today, uh, primarily driven by strong service adoption and enhanced pricing, etc. Um, Also, BON has a really solid, impressive top line growth. So, averaging around 31% per year in the last 5 years, and driven like primarily through organic expansion. The company now still operates with limited profitability, with slightly negative free cash flow, but I think like it is very close to the tipping points towards healthy profitability. I think BLN is like an underappreciated growth story. For example, like in the most recent quarter, the company reported an annual recurring revenue for its service of around 80.2 million, basically up 29% year over year. And the BON solutions demonstrate an unusually high customer loyalty with the dollar retention rate of like 128%. So basically, customer not only stay with them but tend to spend more on their solutions. And also, the company already delivered 34 consecutive quarters of year-over-year revenue growth, really highlighting the predictability of the business model. Also, um, like EBIT margins improved tremendously in the last few years, from like a huge negative 61% in like 21 to now only 3.9% on a trailing 12-month basis. So I think it is still a very early growth story, and the market has yet to fully recognize it. Especially like the momentum is pretty solid in the last few years. So yeah.
Yeah. Yeah. It's a really good name. Yeah, it is. Like, I think, you hit the nail on the head with it being an undervalued, kind of underappreciated growth story. Like, when you look at the combination of a 5-year revenue CAGR of 31% mixed with that expansion in gross profit margins and just leaning more towards that like services kind of base segment, it really does have like all of the makings for, a really nice, like recurring, predictable sort of business with expanding margins, kind of exactly what investors, typically want to look for. And at a trailing price to sales of like 4.4 times, not too bad. And when we look at, forward, it's probably even a little bit better with high growth estimates. So, and it's a really healthy looking chart too, like over the past couple of years. I mean, that trend is pretty solidly up and to the right. And yeah, we haven't really seen too many questions on this name, but it's certainly kind of gone under the radar. And the business, it's maybe not as exciting as like an AI pure play, but that's kind of the beauty of it, is that, it's something that's necessary for some of these working environments. But they can still scale and grow with different tech innovations and things like that.
Yeah, I agree.
Nice.
Yeah, it didn't screen well like with the profitability metrics like EBIT positive, because like they still like, and they also only improved the cross margins in recent quarters. So yeah,
Right.
yeah, yeah. So I think the story will get more interesting and will catch attention of a lot of people from now on.
Nice.
Yeah,
Yeah.
and
Nice. I like it.
yeah. And what name are you talking about today?
Yeah. So I'm going to be looking at ZOMD Technologies. The ticker is ZOMD. So this is a marketing tech company that specializes in mobile first user acquisition, engagement, and ad monetization for apps and digital brands. It's really just like a single platform that allows advertisers to manage campaigns across several different ad networks, social channels, influencer partnerships. So it really like consolidates all of these media sources into one single control center. It leverages AI and data analytics, which helps to optimize return on ad spend. It's shifted its business model from a loss from years ago to now being consistently profitable. Previously in previous years, it was investing aggressively in marketing, client acquisition, and some tech products, but it wasn't really showing any revenue payoff. But now, management's tightened its marketing spend. It's managed those overhead expenses. And that's really helped to drive profitability. And, once it built out these AI driven optimization and campaign management tools, any incremental clients have really just been adding revenue without much, variable costs. So it's a really good, they have really good operational leverage. It's a small name. It's about $225 million in market cap. There's no analyst coverage, so there's no forward multiples for valuation. But when we look at it on a trailing basis, it trades at about 11 times trailing earnings and 2.3 times trailing sales. Margins are expanding. Sales growth has been about 80% in the past 12 months, so pretty significant growth. And then looking at this chart, we have its price in the top, its sales in the middle pane, and then the bottom panel is EBIT, all on a last 12-month basis. So, we can see that cyclicality with its revenues and profits. They really dipped into 2024. In general, companies kind of tightened back their ad budgets, so that was one factor. But also, ZOMD just kind of over-focused on its own innovation or its own aggressive marketing spend, which impacted profitability. But now we can see a lot of that's expanding once again. It's becoming highly profitable, and the share price is kind of reflecting that. And yeah, at 11 times trailing earnings, it's fairly cheap for a name that's growing at 50 plus on the top line, at least over the last year.
Yeah, certainly sounds interesting. Trading like 11 times and growing like 40-50%. It sounds too good to be true.
Yeah,
But
and
it
a lot of that
looks interesting.
Yeah, it's a really good point because it's trading at this cheap valuation, so naturally investors might think oh, it's just it's undervalued or really cheap, but a lot of that cheapness is likely reflecting in some cyclicality of the ad market and just how ad budgets can get slashed pretty quickly. So there is a lot of cyclicality in the technology, but they're using a lot of AI, which can help with operational efficiencies, and we're kind of in a bit of a boom market where marketing budgets are seeming to rise. So looks pretty good right now.
I never heard of it, but if they could continue to keep a top growth of this rate for a few quarters, this stock could really fly. I mean, the momentum could really last for some time.
No, for sure. Okay, cool. And then you have a section on public SaaS companies and the AI theme, I believe.
Yeah, that's correct. So today I want to discuss about public SaaS and AI, is it eating software, all kind of stuff that's been around, the headline recently. So just a background, a few years ago, investors were super excited about the prospect of software as a service companies, due to many favorable economic characteristics like subscription-based business model, capital light, sticky solutions, high gross margins, 80% plus, significant pricing power, etc. So investors a few years ago treated every SaaS companies like all of them would eventually become Microsoft or Intuit one day, and it seems like nothing can go wrong. And till today, like the narrative is like artificial intelligence AI is eating software. So so the sentiment has shifted like completely. Like SaaS businesses went from being like an ideal business models to like being extremely vulnerable with the emergence of AI. And the narrative is like AI will replace the vast majority of software offerings within the next few years. Um, and I think um, this the reversal in investor sentiment is pretty dramatic, and with I think like it's once again become attractive. Uh, it is true that some businesses like Adobe software, once a behemoth, could be at risk of being replaced. But I think the vast majority of like SaaS businesses will not be disrupted anytime soon, if ever. Um, and I believe like SaaS will be is still one of the best business models ever created. Though uncertainty is pretty high now, but I think like investors who buy like a basket of highly diversified SaaS software companies could do pretty well from the current levels, given the negative sentiment and the discounted valuations. So the chart right there shows that like high quality software names like Intuit, Salesforce, and ServiceNow, even Constellation Software recently, all trades at like lowest valuation multiples in years, and their growth rates do not change much with AI and all that stuff. Like that's been around for like 3 years or something. So I don't think like they will. Of course, like things could change in the future, but for now, like they don't change the growth story of these SaaS companies that much yet. So I think like the risk reward is quite attractive for the software space in general.
Yeah, yeah, definitely. I wholeheartedly agree on that one. And I think, yeah, this is kind of like a really pertinent discussion right now because, you know, we're seeing it a lot in the news, and you and I have talked about it in the office as well. Like just on the discounted valuation that software names are getting right now, and the whole thesis around, you know, AI eating software and eating the world and everything like that. And, you know, yeah, I think that there's a lot to be said on this, and I think that, you know, largely though, to me, it's really interesting because like we have, and I messaged in the group chat this morning about this too, and it's like to me, there's this huge, you know, investor paradox right now where, you know, on the one hand, investors are believing that like software names should re-rate lower as AI could disrupt their business models or disrupt them entirely. So, you know, essentially it's like sell software names because of that. But then on the other hand, we have some of those same investors saying things like, you know, the AI trade has gone on too high and too long. Some of those names are overvalued. And like, is this maybe a bubble similar to like .com? I kind of mentioned that like, you know, you can't really have both of those statements be true at the same time. It's just, you know, it's kind of missing something. Like, I think a lot of it is, you know, there's got to be a second order or third order effect from, you know, if AI is truly eating software, then what's the next kind of like what's the next derivative or what's the next thing that someone can benefit from? The most immediate is AI. So then, you know, if an investor believes that they should sell software names because AI is going to disrupt them, then the logical conclusion would be, you know, buy AI. And although there's not many like AI pure play like software names out there, like you can't buy like OpenAI, for example. But, you know, investors can buy Microsoft, which owns a decent portion of OpenAI, or, you know, hardware manufacturers or data center plays. Because even though the space might seem like it's grown a lot, if AI is truly to disrupt software and the entire world of technology, they're still going to need more chips. They're going to need more computational power. Like this story is not over yet. So that's why I kind of mentioned on a previous podcast too that like the two are a pretty natural hedge right now. Like if, you know, an investor buys AI stocks, like hardware names, chip manufacturers. Then they also buy software names. That's kind of, they should cancel each other in that sort of investor sentiment and fear around AI disrupting everything. So yeah, and you know, I truly believe that I don't think that the AI trade is over. I don't think that it's a bubble. You know, I kind of mentioned today, like Nvidia at 30 times forward earnings seems fairly cheap if AI truly is to disrupt everything and software, if that's what an investor believes. But you know, I believe that, you know, there's still more long-term runway for the chip manufacturers and the AI space. But I also believe that software names should re-rate higher, since, for one, a lot of these names can benefit from AI, and two, I think the fear around it's a little bit overblown at this point.
Yeah, I agree.
Yeah,
yeah.
and
Yeah, I do think like on one hand, like software names like look attractive, but it doesn't mean like the AI trade really ends anytime soon. Like you see like almost every day like headline now, like um this company got a new contract with another company, and stock just jumped. So like yeah, I do think that the theme still catch attention of a lot of people and a lot of capital right there. Yeah.
yeah. Like the longer this goes on, the more I'm seeing opportunity in that space, and yeah, you know, and it goes back to CSU as well. I think that I think investors need to like really critically look through that narrative and kind of and decide which side they want to be on. But also, you know, historically, the tech market has expanded at a fast rate for a reason, and so I wouldn't be surprised to see both of those spaces win over the long term. So, yeah, I think, yeah,
It's likely.
yeah. So, you know, that kind of brings me to I'm gonna jump ahead to my like CSU kind of segment, because I think it kind of connects pretty well with this. So yeah, I wanted to share some analysis that I've done on Constellation Software, because you know, it's been getting hit hard for a couple of reasons recently. So one is that you know, Constellation Software has been being sold off due to fears around AI, and that AI might disrupt some of its verticals. But then secondly, the CEO, Mark Leonard, resigned and stepped down. So there's a bit of investor fear and anxiety around some of that transition. But I wanted to share this analysis of CSU's stock price. And so essentially, what I did is I looked at the forward 3-month, 6-month, and 1-year returns for Constellation after it underperforms the TSX for 3 consecutive months or more. And that's really happened in, you know, I'd say was 1, 2, 3, 4, 5 years, essentially, including 2025. So it was 2008, 2017, 2020, 2022. So Constellation underperformed the market, the TSX, by 3 months or more in those periods. And the forward, you know, 3-month, 6-month, 1-year returns for Constellation after that was pretty substantial and pretty significant. So only 3 of those timeframes are negative, whereas the remaining are all positive. The average forward returns are quite strong, you know, 8% over the next 3 months and 6 months, and an average 32% over the following year. You know, and it is interesting too. It is important to note that most of these timeframes were bear markets. So 2008, not so much 2017, but 2020, 2022. So the real exceptions are today, being 2025, and January 2017. 2017, there was a few fears around, you know, cloud disruption and things like that, disrupting some of these software names. So, you know, if I were to draw the one parallel, it would be from that 2017 timeframe. to the current one. But largely, I think, even still, even if we look outside of these just being in bear markets, I think, it's a good testament to CSU's kind of resilience over time. And then also kind of on a similar vein, we have CSU's relative performance against the TSX over those same sort of timeframes, following, its underperformance for 3 months or more. And so basically on all timeframes for 3 months, 6 months, 1 year, it outperformed the TSX every single time after it underperformed for 3 months or more. So, it could always be different this time. But these sort of stats, and with this sort of a caliber of company and management team, it's simply not a stat that I would personally be betting against.
Yeah, definitely. Yeah.
Yeah.
I also want to add, like, this time probably is like the largest drawdown since CSU went public back in like
Mm-hmm.
06 or something. So this drawdown was
Yeah.
even larger than like 08, 09. Of course, like we don't have AI back then, but
Yeah.
but like our experience is that it is a little bit unwise to bet against like a great management team and all that stuff. Also, we are trading at CSU is like trading at one point, which like a few years from now, time will tell whether this one is like a once in a decade kind of buying opportunity, or like this time would mark like a real slowdown in like the business model of like vertical market software.
Mm.
So yeah, it's pretty extreme now.
It's pretty extreme. Yeah. No, it's true. It is. It's hard to know, and it's hard to, look into the future and kind of like foreshadow exactly what's going to happen. But I think, there's a possibility that AI disrupts some of this, and that's what the market's pricing in. But yeah, I think from my experience, I've seen this sort of fear in certain names time and time again. And, like we saw it with Meta in 2022,
Right.
Individuals bet against a really strong management team, and they got really fearful and really worried about the overspending and the negative returns on that one, Meta kind of segment that it was spending money on. But management was able to turn it around. And, I also wrote an article about how there's been, several countless successful CEO transitions over the years. Tim Cook moving in place of Steve Jobs being an example. And so I wouldn't be surprised to see something like that again with Constellation. And, I said it on the podcast with Ryan that I think, or maybe it was with you, but I think this is a like the Tom Lee equivalent of a granny shot. But I'm moving it up to a super granny level. So yeah.
Yeah, definitely bullish on it.
Definitely bullish on it. I mean, this is classic. Just and I know we're kind of going long on this, but essentially, like in April, we saw the market sell off heavily, just the broad market in general. And I kind of wrote and did a video on how, markets can get really euphoric near the tops and when things are going up, but they can also get those same sort of emotions when things are going down. Like people can get extremely fearful and it just kind of grows on itself unnecessarily and unwarranted. And it's just kind of a tough emotion to manage. But I think that's what we're kind of seeing with Constellation, where it's a bit irrational due to, CSU's historical performance, its caliber of management team, everything else. I think that, when you look at the odds and probabilities, I personally think that, yeah, CSU is kind of a high odds kind of play right now. So,
Right. risk-adjusted returns kind of thing.
Yeah, that's right. Yeah, fully.
Uh,
Yeah.
I
So I
agree.
know,
Yeah,
yeah,
yeah, the setup is quite
yeah.
attractive.
That's right. Yeah. I know we kind of went a little long on that one, but yeah, I think it's really important to kind of highlight right now. But I'm going to move on to the next section for interest rate cuts and market returns. This is a graph that I've been following for some time now. It's something that I, populate every so often and just kind of follow it. And it's looking at the S&P 500's cumulative 2-year returns from the moment that the U.S. Federal Reserve cuts interest rates for the first time in, at least years. So, there's several different past instances here. We have 1984, 1989, 1995, 2007, 2019, 2000, and 2024. So it's looking at the cumulative return. So when we look at this just kind of as it is, it might be a little bit noisy, but when we segregate it like this, it makes a little bit more sense. So essentially what we're looking at is really just two groupings of different return profiles following the first interest rate cut for the US. So the one here is what the market does in a non-recessionary cutting cycle. So these were all instances where the US Federal Reserve cut interest rates and the market rallied for the next 2 years pretty nicely up into the right, going up between 20% to 60% over a 2-year period. So that was, 1984, 1989, 1995, 2019. And so far, 2024 is the Blackline, and that's kind of clustered in there. And then on the other hand, we have recessionary cutting cycles. These are where, the Federal Reserve sees something in the market or in the labor market or the economy that points to some distress, and it cuts out of necessity to kind of stimulate the economy. And we really have these two instances where the forward 2-year return was negative. That would be 2000 and 2007. So that's like the return profile for a recessionary cutting cycle. And then just kind of outlining where we're at so far. So it's been tracking pretty nicely. We had that dip in April, which kind of lines up with exactly, basically that COVID dip is right there as well alongside it. And, if we track it out, so we're about 20% up and about 1 year into the cutting cycle. And then, looking out the next year, those non-recessionary cuts, the market typically rallied to up to 20 to 60% with an average in that, roughly 30 to 40% range. So pretty solid, pretty encouraging. Doesn't necessarily mean that that's where we're going. But, if history is any guide and the market returns are any guide, this is looking pretty healthy so far.
Very interesting. Yeah, never heard anyone like discuss like the interest rate cuts and what will happen with the market's returns based on like the real economy situation. Yeah. So yeah, I think we are on a good trend here for like a solid returns after like at the beginning of the interest rate cut cycle. Yeah, I think those things are pretty insightful.
Yeah. There's many different ways to slice it, but I think the history, like typically people talk about like when the Fed starts cutting rates, markets kind of flatline or go down. But I've looked at it in the forward 1 year. Usually the markets are up decently if it's non-recessionary, but they're usually down if it is a recession. So the first year we were up since the beginning of the cuts, and then year two tends to be pretty good. And then also when either rates bottom or they top, and then the central banks decide to pause interest rate cuts or hikes, the market also tends to rally in those instances and does really well because it prefers certainty. So the markets don't like uncertainty, and they prefer at least less uncertainty. So yeah, when they get some sort of pause, it kind of helps to signal to businesses what they want to take on debt at and things like that. So yeah. Okay. Yeah, and then I think you have a segment on one interesting ETF.
Yep. Sure. So the ETF that I want to discuss about today is about like durable quality kind of moat businesses. So one of the classic investment lessons of Warren Buffett is like to purchase businesses with a moat, and what he refers to like is investors should look for companies with durable competitive advantages uh, that can like endure for decades. Um, and the question here is like, why should investors target companies with a moat? It is because capitalism is extremely competitive. Once like someone figures out a niche that is highly profitable, sooner or later it is going to catch attention of a lot of copycats and competitors. And without anything to differentiate themselves, like competition will eventually drive out the profitability of that industry. However, there are some like industries and sectors that really have like significant barrier to entry, and in some cases like nearly impossible for others to copy. um, and as a result, these companies with like significant competitive advantages tend to like really tend to be really resilient business model with with durable growth and strong profitability. And here modes can come from various form, like whether tangible or intangible. For example, like the classic one is like real assets. So companies that possess like that own monopolistic hard assets like to the society, like railroads or toll roads, like can have really strong pricing power. Or secondly, like network effect. Like imagine people choose Visa or MasterCard because like merchants tend to accept like payment methods with a lot of users, and users tend to select payment methods that are accepted by a lot of merchants. So these advantages are self-reinforcing. Also, the third kind of competitive advantages is like regulatory mode. Like, for example, the rating agencies have been dominant, like by Moody's, S&P, and Fitch for like decades. Uh, it is mainly because like in order to be able to provide ratings for issuing bonds, these companies must be granted the designation of like nationally recognized statistical ratings organization. So these require tremendous regulatory inspection that a startup may not be able to afford. And the last one is like intellectual property, like think of trademarks, copyright, patents. Like if you're the only company that sell like life-saving medicines, like it is pretty profitable to sell that product. And so yeah, this ETF would mainly help investors cover the topic of multi businesses. And here's like the a few large positions within the fund. Like first one is G Aerospace, the aerospace company that provides parts for aircraft engines without like second source. Visa is like payment processor, the largest payment processor in the world. Intuit, like it is famous for accounting and tax software like QuickBooks and TurboTax, etc. Also, Performance Food Group, it is a less well-known company, is like the distributor of food-related products to individual restaurants. And the next one is like CBOE Global Markets and Intercontinental Exchange. Those are like uh, the operator of regulated marketplace and listing and derivative tradings and financial security, etc. So overall, we think like competitive advantages could act as a solid barrier to entry, and companies with significant moat tend to be more enduring and more resilient in times. And these companies can grow for like decades and potentially become interesting vehicle for investor to like create life-changing wealth. Um, yeah.
Yeah, that's solid. Wow. Yeah. I've never heard of that ETF before, but the holdings look amazing. The stock chart looks great. I mean, it had a drawdown alongside the market, but it's been holding up really nicely. You know, it's been rising since inception. That's a really interesting ETF. Yeah, I like that one. And it's a good spread of names too. It's not all just like consumer staples or anything like that. It's a lot of, you know, there's financial names mixed in with some tech names there as well. KLA and Lam Research. So yeah, that looks great.
Yeah. It's a fairly new ETF, but like the strategy would be like pretty durable, I think, in most market environments. No.
Right. Yeah. Yeah. It's another good point is it's a good, that's a good spread of names for like a defensive type of positioning, which I think is important as we see the markets kind of roar higher. And a lot of names can get stretched on valuation, and no one really knows where any sort of cycle top could be. These sorts of names are pretty durable, resilient across different market cycles, and so having exposure to something like that, can be really beneficial to a portfolio in times of uncertainty or potential, uncertainty coming up in the future, sort of thing. So yeah.
I agree. Yes. Yeah.
Sweet. Yeah. That's great. Nice. I like that. Okay. And
the last section. So Chris is gonna talk about like Chris is gonna teach us like everything we should know about crypto before investing in the space.
Yeah, essentially. Yeah. I mean, so for this one, I want to talk about, I guess, not so much like I want to talk about like really just like hone in on Bitcoin as well, because I know there's been like a lot of so I guess to back up a little bit, I think one of the most important things before investors like learn and think about crypto or anything like that is understanding Bitcoin, because Bitcoin is kind of like the base layer. It's the first thing that I think investors should kind of have a general understanding and framework for, so that they can then layer on top of that understanding and learn other cryptocurrencies or other networks, because they essentially all rely on the same sort of technology, which is blockchain. And then, it just branches out from there in terms of expanding the, technical applications of what people can do with blockchain and stuff. So I wanted to highlight, this 3-point kind of thesis, this mental model that I've created for Bitcoin that has really helped me understand the few different ways that individuals can understand Bitcoin and relate to it, but also 3 different elements that really tie it all into one kind of holistic idea. So, Bitcoin is one of those assets that kind of seems to fade from the headlines, but then, it'll just roar back every few years at new highs. So each cycle, it brings in fresh curiosity from investors. But we find that like most cycles, investors still kind of grapple with like, what exactly makes Bitcoin valuable? Why do some view it as a breakthrough while others view it as just pure speculation? So I want to approach it through these 3 different mental models, different lenses that really help to explain its appeal. So the first one is the technologist lens. That's kind of like the cultural angle. So, inherently, Bitcoin is pretty much a millennial and younger sort of narrative. It can be likened to the internet of money. It's open source, decentralized, not controlled by any single entity. And today, we only really have one other form of money or store of value like that, and that's gold. But Bitcoin being, essentially digital gold, makes a lot of sense to millennials and younger generations because they're digitally native. So millennials, myself included, we were kind of raised on the internet. So we came into this world and the internet kind of just existed, or at least it was just burgeoning. So it wasn't this weird new phenomenon to us, but it was basically something that was always there. So having a store of value that's digital and from the internet, born on the internet, by the internet, it makes a lot of sense to millennials and the younger generation. And so that's kind of the cultural angle to Bitcoin. Then there's the economist lens. That's the second element. So this is like the philosophical kind of angle. So Bitcoin has a fixed supply. Many have heard this before. There's only ever going to be 21 million coins, which is unlike dollars or fiat currency, which is constantly expanding and has no hard cap. And now I think one thing that often investors kind of trip up over is the 21 million coins, because it's like an arbitrary number. It's kind of hard to wrap your head around, like, what exactly does that mean? Like, is that a lot or not a lot? But for example, there's, some odd, I think it's like 45 million millionaires across the globe. So essentially it means like there's not even enough Bitcoin for one Bitcoin for each millionaire in the world. So when you think about it like that, that's reflecting its scarcity. But it's based on code and math. So we know exactly how many coins will be mined each hour, each day, each year, all the way into the future. And we know like roughly at which point, at which year all 21 million coins will be mined. So its supply is fixed and limited. This means it has upwards potential when coupled with rising demand, kind of simple supply and demand economics. So it makes it appealing to some because there aren't many assets out there with a fixed supply. We look at housing, there can always be more houses built. And when someone thinks that there's enough, like land mass that's been built on, well, we can always just build vertically up. So stocks, companies can always issue more shares, even if they write a contract saying that they're not going to issue more shares. They can always change that and go and issue more shares, and it's never a certainty what they're going to do. So gold is really the only main competitor in that space in terms of a hard fixed supply. And they're different in that one's rooted in code and math and one's rooted literally in the earth. But that's where the cultural angle is so important in terms of who are the buyers, who are the main, where's the demand really coming from. And then lastly, it's the sociologist lens. So this is kind of the political angle. So Bitcoin, its origin story is pretty interesting. And it really wasn't just built randomly. It was a very intentional kind of creation. It started as a movement. It was designed to give people open access to financial systems without having to rely on banks, governments, or gatekeepers. So in the developed world, we don't really have to, worry about that. We don't have many issues with access to financial systems. We have pretty low fees and good access to bank accounts. We can, get access to foreign currencies pretty easily and cheaply. But in many parts of the world, that infrastructure doesn't really exist. So individuals in developing nations that want to send money globally or store their wealth somehow, they have to resort to banks that sometimes they can't necessarily trust, or maybe the fees are really high. Or if they want to store physical assets like gold or dollars, it's really in their households, because trusting a financial institution might not be the best course. So this is where Bitcoin kind of offers a different path. It's where anyone with a phone and an internet connection can send or receive value globally. They can store wealth in their pockets, or even in their head if they want to rely on remembering the password. So that's where it's kind of this fascinating movement in terms of what it can do, who's really the main demand source for it, and kind of why it's so important and also valuable.
Very interesting. Yeah, I agree. Like, sending money abroad is like a hassle for like the traditional financial system. Like, needs a lot of paperwork and it's costly and it's slow. Crypto blockchain technology really helps solving that problem. Also, I came from like emerging countries, so I understand like the currency there is not as safe as like the US dollars or like Canadian dollars. The risk of dilution there is pretty real. So I think it's interesting. Bitcoin really do have merits with those perspectives.
No, it's a really good point. And like, I could talk about this for hours, but there's lots of interesting stats, like with the Turkish lira. So I think, some have heard about like the hyperinflation that Turkey has been experiencing. It's, something like 30+% annual inflation rates. And so when you have inflation at 30+%, essentially as soon as the dollars hit your bank, those people really just want to spend it as soon as it hits their bank, because it becomes worthless by the hour. And so, there's, when you look at Bitcoin priced in the Turkish lira, like I think even in the bear market of 2022, when Bitcoin drew down massively, against the Turkish lira, it was like hitting new highs not long after. So because it holds up relatively well to hyperinflation and high inflation kind of currencies. So it's a fascinating asset. There's a lot of like tech components to it, but also some, philosophical kind of cultural and other movements.
But investors should do their own homework before owning anything, right?
Yes, definitely. Yeah. So research is critical. Yeah. I think that's all for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.